when you're purchasing a company, obviously there's a lot that comes with it, but in order to do your due diligence, what historical information do you need during an M&A transaction?
Yep. So generally what we ask for is we'll ask for, depending on the scope, right? Like there's different levels of tax due diligence that you can do, but a regular scope would generally look at 3 years of historic income, federal and state income tax filings, and then 2 areas of non-income tax, meaning, payroll tax, state unemployment insurance, sales and use taxes, things of that nature. And then, the other thing we always ask about is, any acquisitions, dispositions, divestitures, meaning, actual entities. If the company has acquired an entity because of the successor liability items that we've mentioned before, as well as, divesting itself of any of its assets or, group of assets. So I would say those are definitely the most important, and those are the areas that are typically covered in a regular due diligence scope.
Great. So, I just bought a new company. I'm really excited, ready to get this company going. What are the tax implications of taking cash out of the selling business after a transaction?
Great question. That is largely going to depend on the type of entity. So, if you're a if you sell a C corporation, generally what's going to happen is if you sell the stock of that C corporation, the buyer is going to purchase that stock directly from you. So there would be no need to, take money out of the corporation. There are circumstances where if you sell an S corporation and you do a pre-transaction restructuring, it is possible that you have a ton of cash sitting on the balance sheet from the transaction. I won't go into details on how that happens here, but generally in the context of an S corporation, you would basically do a shareholder distribution. And at that point, you would have to look at what your basis is in your S corp stock. And if the distribution you're taking out of it is greater than your basis, or if it's less than your basis. If it's greater than your basis, you would have a capital gain to report on your individual tax return. If it's less than your basis, then, there would obviously be no tax on that. And you would just have basis, in the stock for the future. Generally speaking, if you do get into a situation where you're taking cash out of a C corp, it's going to be taxable. So let's say you own a C corp and you sell the assets of that C corporation. So obviously the buyer is going to give cash to the C corporation, which sells its assets. The corporation is going to pay tax on that sale of assets. And once that cash is distributed to the shareholders, depending on how it's distributed, it's going to be taxable, whether it's a dividend or a capital gain on the sale or redemption of the stock. So the entity classification is very important. Partnership is very similar to an S corp as far as the basis goes in your stock, or in this case, your partnership interest. But generally speaking, I would say, the adverse tax consequences, would only happen with a C corporation. You could, there's different ways with a pass-through entity such as a partnership or S corporation where you could, do some planning around that.